People think you pay a sunshine tax to live in Hawaii. They think the price of paradise is your entire bank account. They're wrong. Last year, my client moving his tax residency from California to Hawaii didn't cost him money. It saved him $35,000. If you are a high earner, the Aloha State might actually be the biggest tax shelter hiding in plain sight. Let's run the numbers. Hi, I'm Jason Wong. I am a licensed real estate broker in the state of Hawaii, and welcome to the tax breakdown that your CPA is probably too boring to explain to you. We are talking Hawaii versus the mainland. Now, yes, a gallon of milk here costs $8, and shipping an Amazon package takes long enough that you'll forget you ordered it. But when you look at the big three, property tax, income tax, and the infamous General Excise Tax, the math for high net worth individuals gets spicy. Let's start with the undisputed champion of Hawaii tax law, property tax. If you are coming from Texas, New Jersey, or California, you might want to sit down for this. Hawaii has the lowest effective property tax rate in the United States. On Oahu, the residential rate for an owner-occupied home is roughly 0.35%. That is basically a rounding error. Let's do the math. Say you own a $2 million home. In a high-tax state like New Jersey or Texas, you are easily paying $30,000 to $40,000 a year just to sleep in your own house. In Hawaii, that same $2 million home might cost you roughly $7,000 a year in taxes. That is a $23,000 difference right there. That pays for a lot of $8 milk. And if you're over 65, you get an even bigger exemption. It's the state's way of saying, thanks for getting old here, please stay. Now let's talk income tax. This is where people get scared. They see Hawaii's top marginal rate of 11% and they panic. And look, 11% isn't zero. It's not Florida or Nevada, but we aren't comparing ourselves to zero. We're comparing ourselves to the other high luxury coastal states. If you are a high earner in California, your top marginal rate is roughly 14.4%, including the mental health surcharge. In New York City, you're pushing 14.8 combined state and city. So, swapping California's 14.4% for Hawaii's 11% instantly keeps 3.4% of your top bracket income in your pocket. On $1 million of taxable income, that spread, combined with the property tax savings, is where that $35,000 savings figure comes from. It's not tax-free, it's just tax better. But we have to talk about the elephant in the room, the GET, the General Excise Tax. Technically, Hawaii does not have a sales tax. We have a gross receipts tax on business. But for you, the consumer, it functions like a 4% to 4.7% sales tax at the register. Here is the sassy truth. You will hear locals complain about GET endlessly. But if you're coming from Los Angeles, where sales tax is 10.25%, seeing a 4.7% tax on your receipt feels like a discount. The catch? It's on everything. Services, rent, medical, food. It's broad, but it's shallow. However, if you are a business owner, listen to me closely. GET is a pass-through entity. You are taxed on your gross receipts, but you can visibly pass that cost to your customer. It is effectively neutral for your business if you structure it right. So let's recap the scorecard. 1. Property tax, practically free compared to the mainland. 2. Income tax, high but still lower than California or New York. 3. Sales tax, GET, less than half the rate of major mainland cities. When you stack these up, Hawaii isn't just a place to burn money. For the right tax bracket, it's a place to protect it. Of course, I am a guy on the internet, not your CPA. Hawaii has a scary estate tax and a high cost of living, so you need a professional to run your specific scenario. But if you're tired of paying 14% to sit in traffic on the Highway 405, maybe it's time to pay 11% to sit on a beach in Lanikai. Thanks for watching. Aloha.